Why do we define this recent market correction as a bear market? And what are we doing in client portfolios? What is our bear market strategy? Well, I'll give you our answers right after this brief disclaimer. Welcome. I'm Glenn Busch. I'm a portfolio manager at American Money Management. That's an RIA based in San Diego, California. And this video is based on our Q2 2020 letter to clients. Now, if you want to get all our letters to clients, all our updates to clients, and our individual stock research, there's a link in the description where you can sign up for our email newsletter. The COVID-19 virus has produced one of the quickest bear markets in histories. We went from an all-time high back in February to bear market territory in about 20 days. The reason being is the coronavirus creates a lot of uncertainty. And as we've said before, the market really hates uncertainty. And the reason why we call this a bear market is, one, you have the standard definition of a price decline of greater than 20%. But we also define a bear market more than just price declines. If a price decline of 20% or more defined a bear market, then the corrections of 2011 and 2018 would have been, by definition, bear markets. But because we had such quick recoveries after those sell-offs, we don't really have what we would define as a bear market. We define a bear market as a series of events. You have duration, you have frustration, you have capitulation, and then you have recovery. The first thing is duration. You have to have a bear market that goes on longer than anyone expected. And this chart that you're looking at is from JP Morgan, and it looks at the duration and the depth of past bear markets by percentile. Now, the current downturn highlighted in blue stands out both in terms of the speed of the decline and the limited duration thus far. And at only around 40 days old as I record this, this bear market likely has more duration left in it. And rallies during a bear market are normal. Now, the rally that we're in right now, maybe it's just a relief rally, or maybe it truly is the end of the bear market and the sell-off by the coronavirus. But if this is like any other bear market and we're going to have a longer duration, you're going to have some more sell-offs and you're going to have some more rallies. And the reason why we think maybe there's potentially a more sell-off is the corporate earnings and GDP numbers haven't really worked their way through the system yet, from shutting the government or shutting the economy down to a complete standstill just within a month or so. The counterpoint is the stock market maybe has already priced in all that bad news, but it's probably unlikely that it's just sunny skies and good things coming down the pipeline in the next few months and few quarters. The next step is just frustration. Because the duration is longer than people expected, they get caught in this vicious psychological feedback loop. You'll see these rallies, maybe they think it's over, and they think it's going to be those sunny skies ahead, but then some more negative news, more selling pressure, and prices of the stocks just keep going lower. And then finally, all that selling and all that negative news leads to capitulation. Even the once stoic investors, those that were trying to stay steadfast and focus on the quality of the companies and quality of the assets, they just can't take the losses anymore, and they sell their assets, realizing those losses in their portfolio. And this cover from Business Week in 1979 with the title Death of Equities is just the perfect example of that capitulation. And once we have capitulation, that sets the foundation for the recovery. Now, going back to the Death of Equities cover as an example, the markets did not bottom once that was published. But the capitulation that everyone was feeling around that time led to the recovery in a 10-year period where stocks produced annual returns of more than 12% per year, nearly tripling their levels from the 1979 publication date. So if American Money Management believes that we are in a bear market, we have to get into what our bear market strategy is. The first thing is risk management. Contrary to what you may be thinking, risk management doesn't occur during a bear market or during a sell-off. Risk management happens before the sell-off, before a bear market. You focus on the right strategic asset allocation and the right rebalancing strategy before a bear market, because when that volatility arrives, it's really easy to let our emotions take over and let our irrational thinking system dictate how we manage that portfolio. But if we go in before this with the right asset allocation and the right rebalancing strategy, we can remove some of that stress, and we can know that, hey, this is the game plan. When this happens, this is what we are going to be doing to the portfolio to take advantage of that volatility. And besides a strategic portfolio allocation and strategic rebalancing, there are other things that we can do within the portfolio that fits into our bear market strategy. As Shelby Davis, the famed value investor, once said, bear markets are where you make most of your money. You just don't realize it yet. Bear markets are ripe with opportunity to increase the long-term returns of your portfolio. And the things that we're going to talk about right now are just some of the small steps you can do on top of a strategic asset allocation and rebalancing. One of the first things is just stay focused on quality. Bear markets provide an opportunity to upgrade your portfolio into some of those high quality names that maybe you haven't been able to own yet. During market panics and during these sell-offs, you have kind of a throw the baby out with the bathwater moment. And these high quality companies that are highly profitable, a lot of cash flow, high returns on assets and invested capital, their stock prices go down as well. And you can trade up to these high quality names at attractive prices and increase your long-term returns. In their white paper, How to Maximize Returns During a Market Panic, Verdad Capital defines high quality companies as those that are highly profitable through net income or have high operating cash flow. And for this white paper, they defined a market panic for when high yield spreads reach 650 basis points over the 10-year treasury. And as you can see in this chart, these groups are broken down into deciles for how profitable they are, how much cash flow they're generating. And you can see on the next 12 to 24 months from when those spreads hit 650 basis points, the amount of excess return that these high quality companies generate. The next thing you can do is to follow the old adage, is to buy low, but we'll add the caveat of not all at once. As we said, bear markets present great opportunities for when the market recovers to have excess returns, but you have to not get wiped out while you wait. We don't know when the exact bottom is going to be, so we have to do our buying into chunks. We know that the duration of a bear market should present multiple opportunities to put cash to work. If you buy all at once on the first dip, you don't have ammunition left over to get any next retest of those lows or any new lows. So you want to take the opportunity to invest and pick your spots to put capital to work into those higher quality names or the other positions that we're going to talk about here in a second. And before I talk about those other positions, one other strategy that you can do during a bear market is tax loss harvesting. The sell-off presents opportunities to harvest capital losses to offset any taxable capital gains. And the beauty of this modern era is that you have ETFs where you can sell one position, find an exact same position, swap into that, realize the losses, but stay invested in case the market recovers and continues to go up. And those tax losses that you harvested, they can be used for current capital gains, like I just said, and also future capital gains. And you can use some to offset current income. I believe the maximum amount this year they can use to offset income is about $3,000 in capital losses. And the last strategy we want to talk about is over allocating to riskier assets. This is the equivalent of turning into the crash when your car is swerving on a slippery road. And just like swerving into the crash, it feels counterintuitive. But by over allocating to riskier assets, you are setting your portfolio up for success when that recovery happens. Now you're overweight those riskier assets that can generate those higher returns as the market rebounds. And going back to that white paper by Verdad Capital, swerving into the crash for equities is over allocating to those high quality companies, again, defined by high net income and high operating cash flow, but also moving down in size. Smaller companies tend to rebound quicker into a recovery than large cap stocks. And on the bond side, you want to move out of the quote unquote safer assets, say US treasuries and investment grade bonds, and move down in credit quality. You want to get into that high yield junk bond territory. And as this chart from that research paper by Verdad Capital, it shows the return expectations for those lower credit quality bonds when we reach this kind of 650 basis point threshold. And right now, the option adjusted spread for high yield versus US treasuries is still around 760 basis points, well above that 650 basis point threshold, not all at the recent highs, but still a good wide spread to present opportunities for investment and moving down that credit quality. So again, our bear market strategy is to have that strategic asset allocation, to have the strategic rebalancing strategy to take advantage of price volatility, to swerve into the crash, to increase our allocation to those quote unquote riskier assets and trade up in quality in stocks and move down in size in stocks and move down in credit quality for bonds. And 4 is to take advantage of the sell-off and do some tax loss harvesting to offset any capital gains and some current income. If you'd like to learn more about our portfolio management style and how American Money Management can help you navigate this bear market, then give me a call at 858-755-0909 or shoot me an email at gbusch@amminvest.com. And check out this video on our previous quarterly letter. And if you like this video and want to see all our future ones, then hit subscribe. Until next time.